Is Google playing a double game with crypto? They just announced a plan to ban unlicensed wallets, but at the same time, they took a big stake in a Bitcoin miner. This is all happening while the US Treasury is quietly building a strategic Bitcoin reserve with billions in seized assets. If you're wondering why the market just took a dive, Ben Cowan says it's because of a surprise inflation report that has companies stuck. CryptoJeb thinks this is just a healthy correction and a huge buying opportunity. Meanwhile, Crypto Wendy shows us the wild difference in how the stock market reacts to big companies buying crypto. One firm's stock got crushed by 50% for buying a memecoin, while another is getting praise for stacking Ethereum. What do these big players know that we don't? In the latest video from Altcoin Daily, the discussion kicks off with Bitcoin's recent rollercoaster ride, where it hit a new all-time high of $124,000 before taking a sharp dive. The main news, however, is Google's new policy to ban unlicensed crypto wallets in the US and EU, set to start in December 2025. The video suggests this is a move to create fear, especially since Bitcoin recently surpassed Google as the fifth largest asset on Earth. It points out the hypocrisy, as Google also just took an 8% stake in the Bitcoin miner TeraWulf. The narrative then shifts to the US government's changing tune. The Treasury Secretary is shown discussing a strategic Bitcoin reserve, which currently holds between $15 and $20 billion in confiscated assets. The plan is to continue building this reserve through seized assets rather than direct purchases, signaling a long-term commitment. On the altcoin front, there's positive news all around. Ethereum's price is expected to rise due to competition between treasury companies like Bitmine and SharpLink. Chainlink is also building its own strategic reserve of Link tokens, and VeChain has landed Franklin Templeton, an asset manager with over $1.7 trillion as a client. The overall message is that despite short-term fear and volatility, the fundamental signs for crypto adoption by major players are incredibly strong. The video does a great job of framing the recent news as a battle between old guards like Google and the new world of decentralized finance. It's interesting to see the do as I say, not as I do approach from big tech. Google's policy on wallets isn't necessarily a full-blown attack, but it's definitely an attempt to control the playing field and force crypto into a regulatory box that they're comfortable with. Meanwhile, the idea of a US strategic Bitcoin reserve is getting more real. While it's largely built on seized assets for now, the fact that it's being discussed at high levels treats Bitcoin less like a speculative fad and more like a national asset, similar to gold. These two developments, Google's restrictions and the government's accumulation, show a clear trend. Major institutions aren't trying to kill crypto anymore. They're just figuring out how to control it and profit from it. In the latest video from the Ben Cowan channel, he breaks down why the crypto markets took a sudden dip. The main reason seems to be a surprising jump in the Producer Price Index, PPI, which measures inflation at the wholesale level. It shot up from about 2.3% to 3.3%, catching everyone off guard since the expectation was only 2.5%. This is a big deal because it shows costs are rising for producers. It's interesting to see the dynamic Cowan lays out. It feels like we're watching a standoff between businesses and buyers. The PPI numbers clearly show that companies are dealing with higher costs. However, the data from restaurants like Chipotle suggests that the average person has hit their spending limit. Companies are stuck between a rock and a hard place. Either they eat the extra costs and watch their profits shrink, or they raise prices and risk losing customers who are already tired of inflation. The Fed's potential rate cut in September just complicates things further. If they cut rates while producer inflation is running hot, it could be seen as ignoring a serious warning sign, possibly leading to more economic instability down the road. In the latest video from Crypto Wendy, she talks about a new trend in the crypto world, publicly traded companies adding crypto to their treasuries. But here's the catch. Not all of these moves are seen as a good thing, and investors need to be careful. She points to a wild example with Safety Shot, a NASDAQ-listed drink company. They announced plans to put $25 million into the meemcoin bonk, aiming to buy up to 5% of its total supply. The result? Their stock absolutely tanked, dropping 50% on the news. On the flip side, you have a company like Bitwise, which is focused on Ethereum. They're looking to raise as much as $20 billion to buy more ETH, adding to the $5 billion they already hold. This move is seen much more positively. This all ties into a bigger market shift. It seems investors are moving away from Solana-based meme coins, which have dropped about 8.5% in value, and are putting their money into what they see as more quality assets like Ethereum, which has jumped 47% this month. The lesson here is that when a traditional company buys crypto, the market's reaction depends heavily on what they buy. A meme coin purchase can spook investors, while a focus on a major asset like Ethereum is treated very differently. It's pretty interesting to see the stock market's immediate and harsh reaction to a company buying a meme coin. The safety shot situation shows that traditional finance still views assets like bonk as purely speculative gambles, not serious treasury assets. Their stock's 50% plunge suggests investors saw the move as a desperate gimmick rather than a sound financial strategy. This is a stark contrast to how the market reacts to companies like MicroStrategy loading up on Bitcoin. It seems there's a clear dividing line. Investors are becoming more comfortable with corporations holding Bitcoin or even Ethereum, but anything further down the risk curve, especially a meme coin, is seen as irresponsible. It really highlights the cultural gap between the wild world of crypto and the more conservative nature of the stock market. In the latest video from CryptoJeb, he breaks down Bitcoin's big drop right after it smashed a new all-time high of $124,600. Instead of panicking, he sees this as a healthy correction and a prime opportunity to buy. He believes the bull market is far from over and even predicts Bitcoin could hit $135,000 in the next 30 days. It's interesting how the video builds a narrative around a triple whammy of bad news. The theory about government manipulation, especially with the Treasury Secretary's comments perfectly timed before bad inflation data, is a compelling story. However, it's worth noting that the current U.S. Treasury Secretary is Janet Yellen, not Scott Bessent. This detail changes the context of that specific point from a factual event to more of a hypothetical concern. The core of the analysis, however, about the PPI data and the CME gap holds up. Higher than expected inflation does genuinely spook markets, and technical factors like futures gaps often act as self-fulfilling prophecies because so many traders watch them. The whole situation shows how easily crypto markets can be swayed by a mix of real data, technical analysis, and powerful stories, whether they're entirely accurate or not.